Hello there, good evening. This is Teacher Wen. Today we are going to be talking about T accounts. T accounts are very important. You cannot learn accounting without learning the T accounts. So let's get started. Okay, first of all, we need to look at the structure of T account. The structure of a T account is just like the letter T. You have a horizontal line on the top and a vertical line in the middle, and you can divide the space into three regions: the top, the left, and the right. Okay, so the topic of today is working with T accounts, and we need to know some basic information, some basic knowledge before we can start working on it. Okay, so let's review something that we learned before. We learned the accounting equation. Assets equals to liability plus owner's equity. Does it sound familiar? Definitely. Assets on the left hand side equal sign liability plus owner's equity. And we are going to tie this equation to the T account. Okay? So let's join them together. Alright, you see that the equal sign is actually the vertical line of the T account. What does that mean? That tells you that the left hand side has to be the same, it has to be equal to the right hand side. Okay? So the left hand side is called debit, the right hand side is called credit. Debit and credit have to be equal all the time. They have to be equal all the time, and we are going to see some examples. And debit is the left side, credit is the right side. That's what we just see here. Debit to the left, credit to the right. The two words come from Latin, debere and credere. So debere is debit, credere is credit. So when we are thinking about Latin word, there must be some kind of curiosity rising up from our heart. What exactly do they mean? What exactly do debere and credere mean? It's not that important to know the meaning, and I'm going to tell you why. Well, the reason why is simply that after you know the meaning, you may get confused. Okay, but let's dive into the knowledge and just try to find out what do they mean. Okay, so debit or debere, it means should or owe. Credit or credere means to trust. Okay, so we know that there are some English words that are related to these two words, like when you have a debt, okay, you are owing people money. When you trust someone, you give that person credit. Okay, so these words we use them all the time, and there are some other words that derive from these two words, but let's try not to think too much about the meaning of these two words. Let's try to simplify. Right? In accounting, debit means left, credit means right. So that's all you have to know. Okay? Because when you think too much about owing or trusting, giving credit or having debt, that kind of concept, it is going to carry you away and you will be very confused. That's what we are trying to avoid. We are trying to avoid the confusion. That's why I put something like this as a conclusion. These meanings are not necessarily relevant in accounting. Okay, and another thing we need to know that debit doesn't necessarily means more or less. Credit doesn't mean more or less. So these are just sides like yin and yang. They are like imbalance all the time. Okay, again, debit has to be equal to credit. Credit has to be equal to debit. Always you are going to see a balance between the two. Okay, and here I put normal balance. Okay, normal balance. What on earth is normal balance? Normal balance is simply the increasing side. So now that we know that in accounting there are two sides, the left and the right, so the side that increases is called the normal balance. The increasing side is the normal balance. I'm going to put here increasing side. Increasing side is the normal balance. Okay, there's no confusion about it. Okay, so we need to know also how to use the T account. Alright, so before we get into the practical use of the T account, let's try to think more about what is the meaning of the accounting equation. Okay, the meaning of the accounting equation, what is the purpose, what's the idea behind this mathematical sentence, asset equals to liability plus owner's equity. Okay, the purpose of this equation is to show equality. Is to show equality between two parts. And that equality is going to reflect the condition of a business. Alright? If I say 1 apple is equal to 25 cents. 1 apple is equal to 25 cents. I am showing that an apple has the value of 25 cents. They are equal. They are equivalent in their value. Okay? And so asset on the left, okay, is equal to the sum of liability plus owner's equity. By looking at this equation, you see the relationship between these two sides. And the T account help us to understand the equality too. Alright? However, the T account shows us the part that increases and the part that decreases. The part that increases and the part that decreases. And it's important to know that about the different kinds of accounts. Okay, here below I have what we call the chart of accounts. The chart of accounts. Okay, these are account titles. Account titles that a business uses. I'm gonna move this inside the screen so you can see. These are account titles that a business uses for the accounting operation. Okay, you have the cash, account receivable, lo lamento, company, supply, prepaid insurance, Pancho supply, that's an account payable, Huangcho capital, Huangcho drawing, sales, advertising expense. These are account titles. Alright, so each account title has to fall under the category of either asset, liability, or owner's equity. Okay, so these three elements of the accounting equation, they are basically the categories. So whenever you look at an account title, you have to classify them. You have to ask yourself a question: where does it belong? when I'm looking at cash, I have to ask myself, where does cash belong? Does it belong to asset? Does it belong to liabilities? Does it belong to owner's equity? Okay? So when I look at account receivable, I need to ask myself, where does it belong? I have to do that to every single account. Okay? So why is that so relevant? Okay. It is relevant because after answering this question, where does it belong, in which element, which category it belongs to, you'll be able to tell where is the normal balance, on which side it increases, on which side it increases, and each of these accounts has a normal balance, a very specific one. Okay, so basically the assets increase on the debit side. All the asset accounts increase on the debit side. You see, cash is an asset. It has value and it is owned by the business. It has the normal balance on the debit side. Also, account receivable, that is a debt in favor of you. You can collect it. It is an asset. It is also a debit. Alright? And supply is also an asset. It has the normal balance on the debit side. Now, let's take a look at account payable. Account payable is the opposite of account receivable. Account payable is your liability. It is a debt. You have to pay. Okay? That's why it's called account payable. So liability, since it is located on the right of the equal sign, the right side is also known as the debit side. That tells us account payable has the normal balance of credit. When your debt increase, when your account payable increase, you can say my account payable is credited. Okay? Alright, so now let's take a look at owner's equity. Okay, owner's equity is what belongs to the owner. The legal right of an owner to claim the asset. The legal right to claim the asset. So let's imagine that a business has a lot of assets. However, not everything belongs to the business owner. Why? Because the business may have a lot of liability. In order for the owner to get what really belongs to him, he has to cancel his debt. He has to pay off the liabilities to get the owner's equity. Okay, so owner's equity, we need some accounts to represent it. The account that summarizes the owner's equity is the capital account. The capital account summarizes owner's equity. And it is located on the right side, on the credit side. So you can say that when the owner's equity increases, it is said to be credited. The owner's equity is credited when it increases. However, we need some other accounts to make it increase or make it decrease. Okay? The account that increases the owner's equity, as we know, when you sell, when the business make a sale, then the owner's equity increase. Right? And that's the whole point. The purpose of the existence of a business, whatever business, is to make sales. To make as many sales as possible. To get profit. To increase owner's equity. So sales is credited. Okay, sales increase the owner's equity. On the other hand, expense decrease the owner's equity. Okay, expense decrease the owner's equity. So the expense account cannot be credited because it decreased the owner's equity. It has to be the opposite side of credit. That tells us the expense account is always debited. Okay? So whenever we do T account, what we are trying to do is to find the increasing side and the decreasing side. Okay? And I have some transactions here for us to practice. And I think it will be beneficial for us to do it. You know, a little bit of practice. Practice makes master. And that's what we're going to do right now, okay? Whenever we read a transaction, we have to first identify the two accounts that are involved. That tells us that we have to have two T's. Two T's, right? Okay, very good. I'm going to copy this. Put it here. Okay. We have two T's here, and now let's go ahead and read this transaction right here. List right here. Okay, it says receive cash from owner as investment. Receive cash from owner as investment. So the business receive cash. It's quite understandable when you see receive cash. Cash is increased. All right, definitely cash has to increase. I'm going to put cash here. What is the other account that is involved? Okay, here you see the keyword investment. Okay, investment is when the owner takes money out of his or her pocket and invest a business. So definitely that money belongs to the owner. He has the legal right to claim the money that he invests. Alright, so it's fairly easy to tell that the account that involved is the capital. Okay, the owner's equity increase and the cash increase in this transaction. Alright, so we have cash and Huangzhou capital. Alright, so this is what I recommend you to do when you put a T account. You wanna put the DR. Let me change the font, and the CR. Okay, just to remind you that, you know, even though it's a little bit redundant and but it's quite important, right? You want to be always reminded that that debit is to the left and credit is to the right. Okay, so here in this case, we know that cash is increased on the debit side, and capital also increase on the credit side. Both of them increase in this case, okay? But they are on the opposite side. So it proves the theory that debit and credit have to be equal. Debit and credit, they are equal. Okay? All the time. All the time. Alright, very good. Now let's look at this transaction right here. Pay cash for supply. Okay, again, I'm gonna draw two T's. And I'm going to identify the two accounts involved and ask myself the question, where do they belong to? Pay cash for supply. We know it's cash and supply. I'm just gonna type it up. Okay, cash, and here is supply. Okay, pay cash for supply, and I'm gonna put DR CR, and here I'm gonna put DRCR. Okay, now cash supply, right? Where is the cash belong to? Cash is in the category of asset. What about supply? Supply is also asset. Okay, both of them are asset. All right, both of them are asset. Now we are going to identify when asset increase, it is debited, right? So which of these two assets increase? When you pay cash for, when you pay cash for supply, what do you get? What do you lose? Okay, you lose cash because you are paying away your cash, and you get supply. Supply is an asset, you are getting supply. So here we see that supply is here. Okay, supply is being debited, right? You increase the supply. Remember, when asset increase, it is debit. All right, and the cash in this case, what happened to cash? Okay, cash decrease. Cash decrease. All right, so cash is being credited. You see that if the increasing side of an asset is debit, then the decreasing side will be credit. We're talking about asset right here, okay? For asset, since it is on the left, it increases on the debit side. In other words, if it increases on debit side, then the credit side will mean that it decreases. Okay, so cash decrease, supply increase, and both of them are asset, and they are equal. Okay, let's imagine that you buy supply and you pay $100. Okay, you are losing $100 of cash, and the supply that you are getting is worth $100. So they are equal. Remember, debit and credit have to be equal all the time. Okay, so you can observe from the two transactions we have just done a very simple fact, that when one account is being debited, the other account has to be credited. When one account is being credited, the other account has to be debited. Okay, so you are always going to be seeing a mirroring relationship, like mirror image. Alright, good. Let's move on to the next transaction. Pay cash for insurance. Okay, this one is fairly easy. Okay, this one is very similar to cash and supply because you just replace insurance, prepay insurance. Okay, so that nothing fancy about this one. Insurance is an asset. So we are going to move on to this one. Bought supply on account from Bancho Supply. Okay, now this one is a little bit different. Okay, this one is interesting. Okay, here we see we bought supply on account from Bancho Supplies. On account tells us that cash is not involved. Okay, when you buy something on account, you are acquiring the goods without paying cash at the moment. It doesn't mean that you don't have to pay. You will have to pay in the future time. Okay, future cash payment is involved. But at the moment, what happened? When you get something without paying, what does that mean? You are building your debt. You are getting debt. Okay? So in this case, we know that account payable is involved. Account payable is a debt that's against you. So let's identify the two accounts involved. Here we have supply, that's one. and we have from punctual supply, right? From here, right here. You are buying supply on account from punctual supply. So that must be an account payable with the specific supplier's name or the vendor's name. It's punctual supplies. So it's right here, this account. People, the advantage of having a chart of account is that you can choose the account title from the chart of account. You don't have to make it up yourself. Okay, so just take advantage of it. Okay, now again, very important thing to do, DR and CR, and we do the same thing here. Alright, now let's take a look. Supply, we already know it is an asset. In this case, do we have more supply? Of course. When you buy supply, you have more supply, okay? So supply, I'm gonna make it increase on the debit side. Account payable punctual supply, it is a liability, okay? When you go to your T account, you see that liability is on the right, so it increases on the credit side. That means that in this case, do we increase our liability? Definitely. Here you are getting supply without paying, so your debt increase, and it increase on the right, on the credit side. Okay, again we see a mirror image, debit and credit. Oh, it's huge. Okay, now let's move on to the next transaction. It's a pay cash on account to punctual supply. Pay cash on account to punctual supply. Okay, here we see that you are paying your liability. Okay, it is very clear. The transaction tells us that you pay cash for what? On account. Alright, you pay cash on account, you are reducing your liability, your debt to whom? To punctual supply, right? So we're gonna copy punctual supply. That's definitely one of the account that involve. And what's the other account that's involved? Cash. Okay, cash is also involved in this transaction of paying your liability. I'm gonna put cash here. Alright, so again, it is a good habit always to put DRCR, debere, credere, truly Italian, I mean Latin, and it's good to remind myself, debit to the left, credit to the right. Okay, very good. Now you pay cash. What happened to your cash? What happened here? You have less cash, of course. When you pay cash, you have less cash. And so if cash is not increasing, if it is not increasing, then it's decreasing, right? And your liability, when you pay your liability, what happened to your liability? When you pay your debt decrease, okay? So if the increasing side of liability is credit, then the decreasing side will be debit. Okay? So it is fairly easy to understand. Okay? So again, we have one credit, one debit. Okay? They're always opposite from each other. Okay, now let's move on to this transaction. It is about sales. Okay, it is about sales. Okay, so I'm going to just erase this, and keep the DRCR. So in this transaction, we receive cash. That's wonderful. Receiving cash is always a good thing. Receive cash from sales. Okay, So these are the two accounts that are involved, right? You can look from the chart of account. Cash and sales are the two account titles that are chosen in this transaction. Okay, when you receive cash, what happened to your cash? More, right? So it's debited. Cash is debited. Sales increase the owner's equity is credited. Okay. So always let's be reminded that when the sale is involved, sales is always credited. Okay, sales is always credited. Alright, good. Now we are going to look at this transaction. It says show services on account to Lola Mento. I'm gonna choose erase this. In this transaction, we see a keyword sold. Alright, so sales is involved. We put why I keep on putting that word. Okay, sales and on account to Lola Mento. That tells you something, right? When you sell service on account, you are not receiving cash, and people are owing you money. In this case, it's Lola Mento. Lola owes you money. She owes you money. So you have a debt in favor of you. That is account receivable. We have account receivable right here. Account receivable Lola Mento. And as I told you before, account receivable is an asset. It is a debt that's in favor of you. You can collect it, and it is an asset. So an asset in this case increase, right? Increase on the debit side. Sales also increase on the credit side. Okay? Now let's take a look at pay cash for advertising. Okay, pay cash for advertising. This one is an expense transaction. You are paying cash for expense. So obviously cash is involved because you are paying cash. And advertising, let's look at the chart of account. Which one applies to it? Oh, right here. Advertising expense. We copy it. We paste it here. Advertising expense. Okay. It's opposite to the sales. When you see advertising, when you see expense decrease the owner's equity. Okay, so owner's equity has the normal balance on the credit. So when it decreases, it is debited. Okay, that's the reason why whenever you see expense account, it's always debit. Like no matter what, expense will debit your capital. Expense will debit your owner's equity. Okay, and you pay cash. You pay cash, you have less cash, so cash is credited. Okay? Alright, so now this transaction says receive cash on account from Lola Mento. Okay, receive cash on account from Lola Mento. We see cash, the word cash here, so cash is involved. I'm going to leave it there. And Lola Mento, we know that from our experience before, Lola Mento is an account receivable. Okay, that is the debt in favor of you. So we see here. And here, what happened to your cash? You have more cash, right? You receive cash, you have more cash. That's understandable. And Lola Mento, account receivable, when she is paying her debt, then the debt decrease, right? Remember, decrease is credit. Yeah, decrease is credit for the account receivable. That's an asset. Okay. All right. Yeah. The last transaction we have is the one right here. It is pay cash to owner for personal use. Okay, cash is involved because you see the word cash. To owner for personal use. Owner has the right to take money out of the business or to take any kind of asset out of business. If the owner wants to take the toilet or the air conditioner out of the business and take it home and use it for himself, he can totally do it. Okay, he has the right. The business belongs to him. So in this case, we know it is called drawing. Okay, drawing is when the owner takes asset out of the business for personal use. Okay, not for the business use, for personal use. Huangqiu drawing. So drawing is very similar to expense in the sense that both drawing and expense decrease owner's equity. Okay, so that tells you something, right? That tells you that drawing has to be automatically applied to debit. And cash, in this case, decrease. When money is being taken out from the business has less cash. Okay? Credit, debit. Alright, so this is the exercise that we do to analyze the transaction by using T account. Okay, T account is a tool, a very useful tool that allows you to see the relationship between debit and credit, and it helps you to identify the balance between the account that's being credited and the account that's being debited. Alright, always let's remember debit and credit, they have to be the same, meaning that in every single transaction there must be an account that is debited, and there must be also an account that is credited. Thank you.